Ladies and gentlemen, today we face a moment in global finance that demands our close attention. Silver, a key barometer of both industrial demand and financial sentiment, has dropped sharply 10% in a matter of days. This is not just a minor fluctuation, it is a clear signal that the financial system is showing stress, and we must ask ourselves why. The term liquidity crisis is being used more frequently in headlines, and for good reason. When markets begin to tighten, when money becomes scarce and credit is harder to obtain, we are witnessing the systemic strains that ripple through the entire economy. Now, why does this matter to us, not just as investors, but as citizens living in this system? Silver, like other commodities, is deeply tied to industrial production, investor confidence, and the value of currency itself. A 10% drop indicates panic, or at least a very real fear among traders and institutions. The hooks here are clear. When liquidity dries up, banks hesitate to lend, corporations struggle to meet obligations, and markets respond violently. The same mechanisms that once fueled growth can now accelerate contraction. This is the dangerous feedback loop that we call a liquidity crisis. We must also consider the social dimension. Who bears the brunt of such a sudden collapse? Historically, it is the working class, the pensioners, and everyday savers. They are the ones most exposed to financial volatility because they lack the resources to hedge against sudden market swings. Meanwhile, large institutions and speculators may maneuver through these shifts with relative safety. Understanding this inequity is crucial. It reminds us that economic crises are not just numbers on a screen. They are lived experiences for millions of people. So what should we watch now? First, observe the reactions of central banks. Will liquidity be injected, or will markets continue to tighten? Second, monitor industrial demand for silver, which will indicate whether this drop is purely speculative or rooted in fundamental economic weakness. And third, consider your own financial strategies in times of volatility. Diversification and caution are not just prudent, they are necessary. The recent 10% drop in silver is more than just a sharp fluctuation in price. It is a powerful signal that markets are under significant stress. Investors and traders often view silver as a safe haven asset, a hedge against inflation, and a barometer of industrial health. When such a fundamental asset experiences a sudden and steep decline, it immediately triggers alarm across multiple financial sectors. Imagine a domino effect, where the fall of silver ripples through not just commodity markets, but also equities, bonds, and currency valuations. This is not speculation. It is a reflection of confidence eroding at a structural level. The first hook here is understanding that these declines are rarely isolated. They reveal deeper vulnerabilities in financial systems that have been building quietly over months or even years. Market stress often begins subtly, with small imbalances in liquidity or sudden shifts in demand. But a visible crash like this exposes those imbalances in stark relief. Traders, seeing the decline, may rush to liquidate positions, amplifying the downward pressure, creating a self-reinforcing cycle. The drop also reflects shifts in investor psychology, where fear and uncertainty drive decisions more than fundamentals. When the price of silver falls this sharply, it forces market participants to reevaluate risk, reassess portfolios, and often to move assets toward cash or more liquid securities. Another critical point is the signal this sends to industries dependent on silver. Electronics, renewable energy, and manufacturing sectors monitor silver closely because volatility in its price can translate to higher input costs or disruptions in supply chains. The hooks here lie in the cascading effects. What seems like a technical adjustment by a policymaker can generate significant behavioral shifts in markets worldwide. Additionally, interventions reveal the interdependence of financial systems. For example, liquidity injections aimed at commercial banks indirectly influence industrial sectors, commodity markets, and even currency stability. The drop in silver is therefore not only a reflection of investor fear, but also a test of policy effectiveness, showing how quickly markets digest and respond to systemic signals. Another engaging element is the tension between short-term stabilization and long-term consequences. Rapid interventions can prevent panic, yet they may defer the necessary restructuring of financial practices that led to the crisis. This delicate balance is a critical hook for anyone following economic trends. Understanding whether a policy measure is a band-aid or a strategic corrective can distinguish between temporary relief and sustainable recovery. Moreover, Policy responses are observed globally. A decision in one major economy can reverberate across borders, affecting trade flows, commodity pricing, and investment patterns elsewhere. This interconnectedness underscores the need for strategic awareness among investors and businesses alike. The lesson is that policy moves are not isolated. They interact with market psychology, industrial demand, and broader financial conditions, amplifying both risks and opportunities. Recognizing these dynamics provides a crucial lens for interpreting the silver market's behavior and anticipating the broader systemic effects of liquidity crises before they fully manifest. Volatility in markets, such as the recent 10% drop in silver, underscores the critical importance of strategic planning, diversification, and disciplined risk management for investors. The hooks here are immediate during periods of market turbulence. Another compelling aspect is investor behavior. During liquidity crises, panic often drives decisions faster than rational analysis. Asset prices can plummet, not necessarily due to underlying weakness, but because participants scramble to access liquid funds, converting securities into cash at any cost. The result is volatility magnified, and markets can swing violently in both directions. A liquidity crisis also exposes the fragility of financial interconnections that are usually invisible during stable periods. Institutions that seem sound under normal conditions can reveal hidden dependencies on short-term borrowing, making them vulnerable when liquidity evaporates. For policymakers, the hooks lie in intervention timing. Central banks may inject liquidity, adjust interest rates, or provide emergency funding to restore confidence. Yet these actions themselves carry risks, sometimes delaying necessary structural reforms while temporarily stabilizing markets. The lessons for observers and participants are profound. Understanding liquidity crises requires seeing beyond headlines and price charts, recognizing that these events are not random shocks but predictable outcomes of imbalances between supply, demand, and risk perception. Awareness of how money flows or stops flowing can inform better decisions for investors. Business leaders and policymakers alike, recognizing the early signs, from rising spreads in interbank lending to sudden surges in asset sell-offs, can provide critical lead time to mitigate losses or capitalize on strategic opportunities before panic becomes systemic. Silver is not only a precious metal, but also a vital component in industries ranging from electronics to renewable energy, which makes its price fluctuations a signal worth examining closely. When silver experiences a sudden drop, as it did recently, the effects ripple through both investment portfolios and industrial supply chains. The hooks here lie in the cascading effects. What seems like a technical adjustment by a policymaker can generate significant behavioral shifts in markets worldwide. Additionally, interventions reveal the interdependence of financial systems. For example, liquidity injections aimed at commercial banks indirectly influence industrial sectors, commodity markets, and even currency stability. The drop in silver is therefore not only a reflection of investor fear, but also a test of policy effectiveness, showing how quickly markets digest and respond to systemic signals. Another engaging element is the tension between short-term stabilization and long-term consequences. Rapid interventions can prevent panic, yet they may defer the necessary restructuring of financial practices that led to the crisis. This delicate balance is a critical hook for anyone following economic trends. Understanding whether a policy measure is a band-aid or a strategic corrective can distinguish between temporary relief and sustainable recovery. Moreover, policy responses are observed globally. A decision in one major economy can reverberate across borders, affecting trade flows, commodity pricing, and investment patterns elsewhere. This interconnectedness underscores the need for strategic awareness among investors and businesses alike. The lesson is that policy moves are not isolated. They interact with market psychology, industrial demand, and broader financial conditions, amplifying both risks and opportunities. Recognizing these dynamics provides a crucial lens for interpreting the silver market's behavior and anticipating the broader systemic effects of liquidity crises before they fully manifest, revealing vulnerabilities and opportunities simultaneously. Observing how silver reacts in real time offers insight into larger systemic trends, showing how investor behavior, industrial demand, and market psychology converge to influence both economic stability and growth prospects. Financial crises do not impact all participants equally, and silver's sudden 10% drop illustrates the stark social and economic inequities inherent in modern markets. The hooks here are immediate, while large institutions, hedge funds, and high net worth investors often have sophisticated tools to hedge against volatility. Ordinary citizens, retirees, and small-scale investors are left exposed to rapid market swings. Pensioners relying on retirement savings, for example, may experience sudden reductions in asset values that directly affect their livelihoods. Long before institutional actors feel any real pain, small investors may panic, selling assets at a loss in reaction to short-term price movements, while those with deeper pockets or access to financial instruments can strategically capitalize on the same volatility. Beyond personal portfolios, these inequities extend to the real economy. Workers in industries dependent on silver, from electronics assembly to solar panel production, face disruptions when cost volatility translates into production delays or workforce reductions. The hooks lie in observing that the effects of market crashes are not abstract. They manifest in layoffs, reduced wages, and delayed investments, disproportionately affecting those with the least capacity to absorb shocks. Another layer of inequity emerges from access to information and advisory resources. Large institutions employ teams of analysts monitoring market trends in real time, whereas smaller investors often rely on headlines, which may lag behind actual developments. This creates a feedback loop where those with knowledge and liquidity navigate crises advantageously, while others bear the brunt of systemic stress. The silver crash also exposes vulnerabilities in social safety nets and financial literacy, highlighting the importance of understanding how markets operate beyond the surface level. For policymakers, these inequities present both a challenge and a warning. Interventions aimed at stabilizing markets often favor institutional actors, leaving broader populations at risk of economic fallout. Recognizing this imbalance is critical for investors, citizens, and decision-makers alike, because it emphasizes that volatility is not just a financial phenomenon, but a social one. Understanding who is impacted, how, and why allows for more informed choices, whether it is adjusting investment strategies, advocating for equitable policy responses, or preparing personal finances to withstand shocks. The story of silver's decline is therefore more than numbers on a screen. It is a lens through which we can observe the intersections of wealth, access, and vulnerability in our economic system. Policy responses during a liquidity crisis are critical signals for markets, and silver's recent 10% drop highlights the urgency and complexity of these interventions. The hooks are immediate. Central banks and governments have at their disposal tools designed to inject liquidity, stabilize credit markets, and restore confidence. Yet the timing, scale, and methods of intervention can dramatically alter outcomes. For instance, a sudden interest rate adjustment or emergency liquidity injection may temporarily calm markets, but it can also introduce distortions that obscure underlying weaknesses. Observers must pay attention not just to the policy itself, but to the reactions it triggers among investors, institutions, and the public. When central banks act, large financial players often move swiftly, reallocating assets, hedging risks, or taking advantage of short-term arbitrage opportunities, while smaller investors may be left reacting after the fact. The hooks here are immediate. Companies that rely on silver for production must quickly reassess costs, renegotiate contracts, or even delay projects to adapt to shifting market conditions. This is not theoretical. Every percentage drop in price can translate to millions of dollars in savings for some firms and significant losses for traders and investors alike. Beyond industry, silver serves as a hedge against economic uncertainty, a store of value that many investors turn to during times of inflation or financial stress. A 10% decline shakes confidence because it challenges the perception of stability that silver has long provided. Traders react rapidly, often moving assets into cash or alternative safe havens, which creates additional downward pressure on prices. The industrial dimension is equally compelling. Electronics manufacturers, medical device producers, and solar panel companies all depend on silver's conductivity and reflectivity. When the market for silver becomes volatile, these sectors face unpredictability in input costs, which can delay innovation and production schedules. The hooks extend to investors as well. Those holding silver physically or in ETFs must navigate the tension between potential gains from a rebound and the immediate pain of depreciation. Speculators and large financial institutions often exploit this volatility, amplifying swings and creating an environment where market psychology can outweigh fundamental supply-demand dynamics. Moreover, silver's dual role as both a commodity and a financial asset makes it a unique barometer of broader economic health. Sharp declines in its price signal not only industrial stress but also wider apprehension in financial markets, hinting at liquidity constraints, tightening credit conditions, or shifts in investor sentiment. Understanding these interconnections is crucial for anyone involved in finance or industry because it highlights how a single commodity can act as a linchpin. The hooks for engagement lie in recognizing how interconnected financial and real economies are. A 10% decline in a commodity may seem purely numerical at first glance, but it has very tangible effects on production planning, investor sentiment, and even currency stability in economies where silver trading is significant. Observing such a sharp decline provides not just an opportunity to react, but also to understand market dynamics on a deeper level, revealing patterns of liquidity, speculation, and risk perception that are often hidden during stable periods. Those who can interpret these signals early are better positioned to anticipate broader economic movements, avoid losses, and even identify strategic opportunities that others might miss. A liquidity crisis is one of the most critical and often misunderstood forces in modern financial systems. Yet its impact is immediate and far-reaching. At its core, a liquidity crisis occurs when cash and credit, the lifeblood of economies, become scarce and financial institutions struggle to meet obligations or provide loans. Picture this. Banks and investment firms, normally the engines of economic activity, suddenly tighten access to capital, hesitant to lend even for short-term needs. The hooks here are clear. When money stops flowing freely, businesses cannot pay suppliers, households find borrowing difficult, and even governments feel the strain of rising short. So, term costs. These disruptions ripple outward quickly. Companies delay expansion plans, halt hiring, or even lay off workers. Not because demand has vanished, but because the system that fuels growth has become clogged. The very mechanisms designed to facilitate commerce, credit lines, interbank lending, and financial instruments suddenly constrict, creating a chain reaction of uncertainty and fear. Proactive decisions can magnify losses, while proactive strategies allow participants to navigate uncertainty effectively. Diversification, for instance, is not merely a theoretical concept, it is a practical safeguard. Investors who spread assets across different sectors, commodities, and financial instruments reduce exposure to a single point of failure. Silver, while historically a safe haven asset, demonstrates that even perceived stability can be disrupted, reinforcing the necessity of balanced portfolios. Another engaging element is the role of timing and market psychology. Investors who panic during sharp declines often sell at the worst possible moment, locking in losses rather than capitalizing on more potential rebounds. Understanding behavioral patterns in markets, including herd mentality and fear-driven selling, provides a competitive edge, turning volatility into opportunity rather than catastrophe. Risk management tools such as stop-loss orders, hedging strategies, and options are practical hooks that can protect capital and maintain flexibility during sudden swings in asset prices. Beyond technical strategies, education and situational awareness are equally vital. Recognizing early warning signs, such as shifts in liquidity, tightening credit conditions, or sudden industrial demand changes, allows investors to adjust positions before crises fully materialize. The interplay between real economy factors and financial markets is another key aspect. Silver's price is influenced not only by trading sentiment, but also by industrial needs, geopolitical events, and macroeconomic trends. Engaging with these underlying drivers provides context, preventing reactive or uninformed decisions. Furthermore, strategic patience is a critical hook of long-term planning. Coupled with an understanding of market cycles, allows investors to weather short-term turbulence while positioning themselves for sustainable growth. Those who maintain discipline during high volatility are often able to capitalize on mispriced assets or temporary market distortions. Finally, observing how institutional investors respond to crises provides invaluable lessons for individual participants, revealing patterns, tools, and strategies that can be adapted for smaller scale applications. Preparing for uncertainty is not about predicting every movement, but about creating resilience, flexibility, and the capacity to act decisively when market signals present both risks and opportunities. Let me close by emphasizing a critical point. Crises are not mere accidents. They are outcomes of systemic pressures that have been building for years. The 10% drop in silver is a warning, not just for traders, but for all of us who depend on stable financial systems. Recognizing these patterns, understanding their roots, and preparing responsibly is how we navigate not just this crisis, but those that lie ahead. Stay alert, stay informed, and remember, markets move fast, but understanding the forces behind them keeps you one step ahead.